Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields back to 3%. Recall on April 24th, we hit 3% for the first time in a number of years. We thought it was going to set off some kind of selling spree, driving yields higher. Alas, that was not to be. We saw yields actually trickle back lower, closer to 290, but today we get them back at 3% and above, actually. We had a 10-year note auction that came out today, was issued just below 3%. So we didn't get that 3% level on the auction, but we were just a hair below it. Again, the market just is not seeing any momentum in either way. We trade down to 290, we get up just above 3%. We're kind of spinning our tires waiting here. Equities continue to rally. The world's waiting for the next what-if moment out of U.S. politics, or maybe it's something out of Southeast Asia, maybe it's something in the Middle East with the Iran nuke deal going away. There's just a lot of things going on, and the bond market's just eerily watching, not seeing any big moves in either direction. So right now, sitting at 3% as we speak. And if you look at market volatility, which typically will, in moments of uncertainty, times of uncertainty, we've talked about it before, market volatility starts to build a little bit because of the fear or greed, whatever it happens to be pulling the chain of the market moving, big move in one direction or the other. And we're just not seeing that. Market volatility saw moments of higher levels as market approached 3% and actually got above it in the 10-year, but it was very short-lived, and the downward trajectory continues as we've already hit 2017 lows, and we're just resting above them right now at 2018 and 2017 lows combined. So we're not seeing the market really anticipate any kind of move, possibly, because if you look at positioning, everybody's short. All the hedge funds, the leverage funds, looking at trading of financial futures data, we can see that the most short in the 10-year bucket that they've been since it started being recorded back in 2006. So it's not ever, but it's a pretty good chunk of time. And they continue to hold shorts. We're at 3%. You would have thought there maybe would have been a little bit of a pullback. Hey, let's cover some of these and see if we can sell them out at better levels, or possibly let's see if we can redirect the money somewhere else. No, we haven't. So I think the theme here is that the higher yields go, you're staying with the trend, which goes along with lower volatility. And likewise, the fact that we're seeing kind of a pause here, there are buyers, natural buyers of treasuries. And look at the 3% yield, compare that to, say, something in Germany or something in Britain, or dare I say something in Japan. I mean, obviously there isn't any competition at this level, at this quality. So equities remain a favorite spot to put money, but treasuries are for certain entities, whether it be foreign central banks, whether it be insurance companies, whether it be money centers, pension funds, whatever. There is still demand there. We're just not seeing it from the hedge fund community. They're short, and they want the market to go lower right now, and I think are banking on it. And with the trend being your friend and lower volatility, it's likely what's going to happen. However, we are going to hit these pause moments like we have seen over the past several weeks, where we just kind of spin our tires waiting for the next it moment. The Fed will play a role in that. Data, higher inflation could play a role in that. But ultimately, the thing that's going to scare the market backwards is when those hedge funds look to unwind and cover those shorts. That will be a messy day, and the exits will certainly be jammed full, and you don't want to be the last one out. So right now, market's sitting pretty at 3%, waiting for CPI tomorrow. This is Todd Colvin coming to you from the floor of the CME Group.